right, so welcome to Capital Discussions, Market Analysis. Before we get started, we have our standard disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know you or your situation, and no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations, and the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And hypothetical computer simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So that's the reality check. So there's our disclaimer. And let's see, I can turn the ball back over to you. There we go.
Okay. Share my desktop, and we want to go to, I'm going to have to end up sharing this one and then get this over here. So that,
wow, that account's really growing like a weed, isn't it?
Yeah, it is. It's, you know, I think that there's been one of the, probably the best single trading opportunity that we're about halfway through, and I'll go through what it is in a minute. But if I come over to here, and just to get us started, just to talk a little bit about where we were last week, what ended up happening, you know, where we end up starting normally is we end up going to resources, calendars, U.S. economic, and then I'll go back to the previous week. You know, a couple of things ended up, I went back too far, didn't I? There we go. Consumer prices, okay, during the week ended up showing that, you know, there wasn't much inflation. Housing starts ended up coming back up. The big thing were the minutes, right? I mean, that's what we were waiting for all week long. So what I wanted to end up showing is what was going on in the minutes. And here, let me take down wrong one. Sorry about that. What I wanted to show was what went on during the week. Okay, last week. And if I end up coming over to here, let me just get a couple more days because we already lost. We already lost last Monday. And let me just make it a little bit smaller. Okay, here was our week starting from last week and also including today. You know, we started off strong, making basically, you know, continuing our recovery from the sell-off that we had at the beginning of the month. We had a little bit of volatility right here on Wednesday when the Fed minutes were released. Things went right down to their very nice support line of their 50-period moving average on 15 minutes and then continued its climb. And we've had this, you know, same thing, this slow grind up. When we were at this point at 1980, let's call it, okay, beforehand, 1985, 2000, which if I come back to a daily chart, 2000 has been in its sights for a long, long time. Tom, I don't know if everybody's as old as we are, but do you remember when the Dow first reached 10,000?
Dude, I remember when the Dow was at 1,200.
You're not supposed to tell everybody we're that old. Anyway, if you remember, we kept crossing over it. I mean, multiple years, right, that we went through it back and forth. With the run-up that we have had, okay, remember, basically we haven't had a 10% pullback basically since the S&P was at 667. Okay, back in March of 2009. So with this, I felt pretty strongly that once we broke to new highs above this level, right around that, let's call it that 1985 to 1990 area, that 2000 was a given. It had to end up happening. Okay. I also know that this is the last weekend of the summer. which means that any of the big money managers, hedge fund managers, big pension fund, they're like, uh-oh, I better get my time out in the Hamptons before the whole summer's gone. So they left Junior in charge that basically said, don't let the market go anyplace. Okay, get it up to 2,000, play with it around here, but don't do anything until I end up getting back after Labor Day weekend. Having said that, and I felt pretty strongly about that, what I ended up doing, and the reason why, if you remember the account, right, this is for you guys that don't end up following, this is from our 500K IRA project. We had 3 losing months in a row, down 7%, and then 20%, a little over 20% last month. We started the month at about 17.4. We're up a little over 90% this month. And here's the way we ended up doing it. The S&P was my hedge. At this point, it was only going to be a hedge for another couple of weeks, so I said, don't need to end up having the hedge at this point. The UVXY, which is the double VIX, we had 2 trades on. One of them, you can end up seeing, is done quite well. It's a smaller trade. It's basically just a put vertical that it's going to go down between now and July. But last Friday, I had a butterfly that expired at 26. And if I come back over to charts, let me come over to charts for a second and put in UVXY. And let me make this a little bit bigger so it's easier to see. Let's get this over here. Expiration. Was it here? Oh, no, you know what? I'm sorry. Yeah, here. Close. Tom, can you see what that C says up there on that graph? Right over here. Okay, what's the close when I hold it on expiration? Right there. Do you see it? Tom, did I lose you?
Oh, no, sorry, I accidentally muted myself. 26?
26 on the nose.
Yep.
Tom, the first time in my life, I stuck a butterfly. On the nose. I had the butterfly, my shorts were at 26. We closed at 26.
Oh, beautiful.
It's life was a beautiful. Now, what I ended up doing was that I ended up playing. Okay, if I come back to the daily charts, once we started to end up coming down here, okay, I ended up playing for well below the money, and I had a nice wide butterfly that I just put on the entire thing below the money, and it just kept inching and inching and inching its way down, and it stuck the landing, right? Absolutely beautiful. The UVXY is a little bit tougher to stick, so if I end up showing you the VXX, I have another butterfly. This one expires this Friday. Here, my short is 27. Okay, and here is the daily chart. Okay, and again, we don't need to see the whole thing. Here's the daily chart. So I think I have a really good chance of this thing floating in, right? Floating in to 27. And if it does, how much do I have left on the table here? Let's go. It's easier to see it this way. I'll just do daily. Let's call it from 2,700 to, you see right here, I have about a little over 16,000.
Yeah,
right?
So pretty good gainer if you hit it right on the nose.
So I got another $13,000, okay, sitting on the table here. Now, let's be realistic, okay? The chances of hitting 2 butterflies in a row in 2 successive weeks is, I should be buying lottery tickets instead of doing this if I have that kind of luck. But do I think that I could end up making another, let's say, $5,000? Can we end up closing anywhere, say, from where we are right here? Can we close from, let's call it, 2780 to 2610, 20? Yeah, I mean, a great trade. One of the things that we've talked about, this one I learned from Scott Sheridan. Okay, whenever you'd ask Scott Sheridan about a position, one of his questions always to you would be, if you didn't have the position on, would you put it on again? And the answer is I would without question right now because I think that now that we touched 2000 today, okay, we finished below it, right? You can see right here that we finished at just about 1998. I'm rounding up 8 cents. That we get a lot of push back and forth around 2000, but the market isn't going to end up, I don't think, moving significantly between now and Friday.
No, so I think it's a good bet that vol will kind of drift a little lower.
Right? And if it drifts a little bit lower, I have another $13,000 on the table.
Right.
Right? So, yes, I mean, this has been the big trade. The other trade that I ended up putting on with the volatility here, I thought to myself, you know, again, I was thinking about the Dow 10,000. There's a chance that we do try to end up running through SPX, or maybe we end up having a sell-off, and then they maybe run it back. But, you know, I would not be shocked, stunned, or amazed if at the end of the year they were still battling over 2,000.
Yep.
So this was the trade that I put on today. Okay, let me get rid of this stuff because I closed out my other one, and this was the trade that I put on. Paid $2.10 for it. It's basically just a 25-point winged butterfly at 2,000 at the end of the year. Right? Spend $2.10. Maximum I could end up making is $25 on it. So this is a Christmas tree trade, not a real Christmas tree where you buy one, sell one, further out of the money. This is I close my eyes, I open up my position, okay, on Christmas morning, and I see if I've been naughty or nice.
There you go.
So, anyways, that's what I've been doing most of the week. Oh, the only other trade that I ended up positioning this week was that while I thought that nothing happens with volatility over the next few days, few weeks, I thought by October, this thing could possibly pick up a little bit. So the trade that I have on for October in the VIX is just an iron condor with my short strikes at 13 and 15. Right now we're at 11 and change. I don't think we do anything, but this is another one where, you know, close my eyes. You know, I'll end up looking at this thing, you know, at the end of September, beginning of October.
Right. Well, very good.
That's what's been going on, Tom. When I look at this week, and part of the reason why I also ended up mentioning this, if I look at this week, there's nothing, you know, huge, okay, coming up. Yes, we have GDP, okay, at the end of the month, okay, but just normal jobless claims, unless GDP is significantly, right, significantly one way or another, you know, I don't see I don't see it having a real big effect. Besides that, it's on the Friday before Labor Day weekend. You know, is there anybody who's even going to be listening to it?
Yeah, they're all looking for their 3 or 4 day weekends.
Oh, is that, well, they have their 3. They need to get at least 4 days in before they have to start working in September again.
Yeah, the Germans are really good at that. They like having their holidays on Thursday, and then they take Friday off, and then usually half of Wednesday. So they have nice long weekends on holidays.
Well, you know, the thing is that during the summer, it's a long drive down to Portugal.
That's true.
You're surprised I knew that one, huh?
Yeah. I've actually been on vacation in Portugal, believe it or not.
So I've been to Faro, okay, in the south of Portugal. Absolutely beautiful place. If anybody's never been there, you should end up going. It truly is one of the great places in Europe to end up vacationing. Tom, that's what I end up having. You know, I'll end up reporting at the end of you know, next. I guess we're going to be doing it on Tuesday because next Monday's a holiday. But for anybody who's interested in the trade, we're going to start to end up publishing these things in a much more formatted way. For those of you who want to end up seeing it specifically, this is the big piece that we end up having on. There are different pieces. We had gone through this on a previous WebEx, that the 2729, when you sell the 27 and buy the 29, it makes no difference if you do it in puts or calls. They're identical. So that's just me leaning my trade a little bit to a pull-in within 7, okay, by Friday's close, and hopefully I'll be somewhere close to it.
Yeah, I basically closed my SPX Butterfly. It was basically maxed out on its profit on the call side. So I had that extra vertical. I just converted it to a butterfly. So it's going to make $1,200 unless we settle in a temporary range in 3 weeks. But I basically got my money out of it, and it's not using any margin. So now I'll be looking to put something else on it.
Okay. There are, and this is something that I've learned from Ian Scott. Ian is my trading partner on the volatility fund that he and I run. That when you have opportunity, do not be afraid to send it in. Okay, trade conservatively, have risk management, but when you have the deck stacked in your favor, you have to be aggressive on it. And I think that over this past 2 weeks, we've really had the deck stacked in our favor, that we were just going to end up drifting a little bit higher, and that there would be a little bit of a battle around 2,000. When those opportunities come and volatility would come in, there was more premium and better risk reward for me doing this in the VXX than there was in the SPX. And because it's an IRA, I don't care about how my capital gains get categorized. So to me, this was just a, when you take a look at what I have open on this, right? I looked at this when I put this thing on. Remember, I put this thing on, my accounts was worth probably about a little under $20,000. This was maybe about 60% of my fund balance, where I risked my $11,000 and change to end up making 22. I thought I had probably better than a 50-50 chance, and they were paying me 2 to 1. Where do I sign up? So, Tom, anything else?
Well, the only thing is Thursday's roundtable. We've got Amy Meisner coming. We've already got about 60 people signed up to come, so we're looking forward to that. Amy's excited, and I think we've got some other people in mind for the next few weeks after that. Monday is a holiday, so we are going to have the market analysis next week on Tuesday at 4:30, and that's on the schedule.
Good. We look forward to that. One of the things, if you guys are listening to this and you haven't seen Amy, I'd really recommend you listen to her. One of the things that's happened to most iron condor traders is that because over the last several years, implied volatility in the VIX or the RVX for the Russell, if you trade the Russell instead, they've come down so far that it's made things extremely difficult. Like, for example, if I end up showing you the VIX over the last couple of years, when you had the VIX and it would end up moving up, how have we traded this over the last 2 years? I mean, the thing is that what volatility have we seen? Practically nothing. The other thing that you can't end up seeing from the Thinkorswim system, right? So I have to end up showing it to you from the live vol system, much easier to end up seeing, is that if I end up coming over here and I end up showing you, just say maybe the, let me just move this over to here. Make this the whole window. Take a look at the first 6 months. Um, when I take a look at how steep these vol skews have been, now remember what the vol skews are. This is showing me, here's the price on the bottom, and let's not go out to all, maybe let's just look at, you know, 50% down, 50% up. When I take a look, or even maybe that's too steep, okay, 25% down, 25% up. When I take a look at how steep these skews are, now remember what this is. This is each of the months is listed here on the left-hand side. So the colors correspond to the dates, and each dot corresponds to a strike. So if I end up taking a look at a strike over here, this is the 1925, and I can see the implied volatility is 13.84. So what this is showing is that the further you go below the money, the steeper the put skews have gotten. What this means is that when you're an iron condor seller like Amy, you're selling a put, let's say, it's someplace over here, and even if you go out to September, you're selling, a put over here at, let's say, 1850, and then you're buying something a little bit further down, maybe at 1825. The difference between those two implied volatilities, what known as put skew, that has gotten much steeper. Okay, when that becomes steeper, that means you have a lower IV on the one that you're selling, which means you're going to get less money for it, and a higher IV on the put that you're buying, which means you're going to pay more money for it. So that means that your risk-reward factors on your iron condors have not been as good over the last, year and a half or been going before that. That being said, Amy's been pretty successful through it, so it's I really look forward to her on Thursday.
Yeah, it should be a good presentation. Last thing before we go, we did have a couple of questions. Ray asked, how do you get the background red and green colors on your left watch list and TAWS?
Okay, hang on a second, and let me go back over to my Thinkorswim. You're talking about this over here, right, Ray? If you go to Setup, Application Settings, is it Positions, Orders, Notifications? Hang on a second, it's over here.
Maybe the bottom edit?
No, I think that wasn't it.
There was another edit with 3 dots. Maybe that was the one.
Oh, okay, yeah. Let me cancel. I think that was over here.
Yeah, that one.
Move up, move down, my Russell. Right click. You know what? I forgot where it was. I thought it was right there. Because is it over here also on my monitor or my analyze, my trade? It is. So I'm going to go back to my setup here. Take a look real quick. Here we go. Okay.
There you go. That's it.
So it was setup, display, and then color watch ticks. And you end up saying, if I say text, let me just make sure. There you go. You see, that is it. I hate when people end up asking me this because, in fact, I don't remember where everything is. It was like once you do it, you kind of set it and forget it. Okay, that was a tough one. Any other easy ones?
Well, that's really it. Andrew just made a comment that Theta has not covered delta risk in the last 2 years about iron condors, and yeah, that's why the iron condor traders have struggled in general.
Without question, that's why they've struggled. What kind of scares me a little bit about iron condor traders, and you see some of this, okay, with the like the put sellers, right? Put sellers have been absolute geniuses for the last 2 years.
Right.
It's And, you kind of end up having the long-term risks in your favor because the implied volatilities of the puts below the money are usually going to be higher than they are above the money, and I get that. Um, but what ends up happening is that when you haven't had a loss in 2 years, sometimes you can get a little bit overconfident. And if those volatilities, if and when volatility ever returns, and I do mean if and when at this point, it can get really, really ugly. That's why, when I do something like, set up my VIX trades, even in October, if VIX goes out to 60, I don't care. I know that I've lost money buying that upper wing for the last 2 years, and if I have to, I'll lose money on it for the next 20 years. I'm buying it. Why? Because it ends up happening. It's not to end up saying that you can't end up playing for volatility to end up always picking up. I know that most of the floor traders, especially the old OEX pit guys, right, the old Thinkorswim guys, they always wanted to end up being long volatility, and they'd make a killing when the market would end up going down. But after a while, I mean, it's just been so frustrating for them for the last 2 years. I don't want to play that, but I also don't want to get my head handed to me in case it does pick up, because it will pick up at some point. So how do you end up hedging your risk? Make sure that you always have your risk-defined stuff on.
Yep. That's the scary thing about Karen, the super trader, with her naked options she's doing. I mean, they're 5 deltas. They're pretty far away, but I saw Charles Cottle had a great video about it, and he talked about the O'Hare trade. Did you see that video?
No, but I heard about it. Why don't you share it with everybody else? Because I'm sure not a lot of people did.
Okay, well, the O'Hare trade was that you'd put a big position on, and then you'd pack your bags and go out to O'Hare Airport and buy a ticket out of the country, and then you'd call back to the pit and see how your trade did. And if you made money, you got your refund on your ticket, came back home. If the trade went horribly wrong, you boarded the airplane and left the country.
So I don't know if you remember, but I remember seeing an interview on Tasty Trade with Tom Sosnoff and Karen, the super trader, the very first time she was on. And she ended up sharing the phone call that she got from the compliance department. Okay, on the flash crash date. Remember, she was not doing this or didn't have clients and didn't talk about it during 2008 when we had, that crash. The flash crash, if you remember, basically lasted one day, right? It was over by the following Monday. Anyway, when asked, her comment was, I was home practicing my Spanish. Okay.
Yeah, I heard.
So I have a client who we run this hedged equity strategy for, where we just basically buy the S&P 500 and hedge it. Okay, very similar to the hedging the rest of my EAB guys end up doing. If you heard me talk about them before, and as we talked about it, if you run that trade and you do a Monte Carlo simulation of 100,000 or a million, okay, iterations, you'll find at no period, okay, of time, if you go long enough, will you lose money. You'll always make money. The problem is that if you're holding this thing, it doesn't even need to be a Black Friday, 1987 type crash. It could end up being through September, October of 2008. You can end up having a life-altering event. My client who was doing this ended up trading. Now, granted, he was only doing with about 10% of his money, but he got a phone call one day from the risk management guys over at TD Ameritrade, and they said, we just wanted to let you know that if the market goes down 10%, we estimate that you'll lose 3 times the value in your account. Now, they ended up estimating it, or it was 15%, I'm sorry, if it went down 15%. They ended up estimating it because what would end up happening with volatility, and the volatility spikes aren't in their models, right? So they looked at it, and I'm like, you're going to have, if you run this trade long enough, selling naked stuff below the money like that, if you run the trade long enough, you're going to have a couple of really ugly losers. Now, when you're trading it that aggressively, you know, one thing that the conversation that we ended up having is that, you know what, I know this might only happen once or twice every 100,000, okay, iterations that you do this, but here's the problem. You and I are not going to live another 100,000 months. And what happens if that iteration happens in 12 or 24 or 36 months from now? This would change your life, okay? Do you want to end up doing that? And the answer is, yeah, he did, but with a smaller amount of money, okay?
Right.
so that it wouldn't be life-altering.
Yeah.
So, the last comment I'll just make, because I have this graph up here, is that Thinkorswim does not do a good job. Matter of fact, they do a horrendous job of drawing your T+0 line. So, for example, if you take a look at this, it says that I ended up losing $630 today. If you come over and say, well, what actually happened in the VIX? I made 37. So they're slightly off most days. So you cannot use the risk analyzer in Thinkorswim. You can in OptionView and you can in LiveVol. I don't have a position on LiveVol on this system. It's on a different system. But if you want, I'll end up showing you how it ends up working next time on LiveVol, because those numbers are correct.
Okay, and Ray made a comment that NA in volume column on the bottom right can cause the trade tab for a better number, or can use the trade tab for a better number.
And I'm sorry, where were the NA? Oh, over here, yes.
No.
And that's because the thing is that the puts are just, they're way off, and they can't end up calculating them. You can end up going, I guess, over to the risk tab. And would this end up helping to see?
Positions P&L.
Oh, I'm sorry. I was looking at this. Okay. Yeah, my implied volatilities are a lot better here. See, the challenge that they end up having, and they don't know how to end up doing this, how do you end up taking, let's say, something like the 10 put that says it has 220 implied volatility on the put, but 40 on the call? The problem is that most of the VIX options are priced off of the corresponding future. So the September VIX options are really priced off of the September VIX futures, and so on, right? The October options are priced off of the October futures, and Thinkorswim doesn't do that. Thinkorswim actually prices it off of the cash, and that's just, you're going to get crazy numbers if that happens, and you're going to end up getting crazy P&L graphs that look like this, which are totally, out of whack. You can end up seeing, by the way, it's not uncommon that wherever this little graph, starts to bend, is where the futures are going to trade to. It's going to be like the closest dollar that they trade to. And if I come over and I take a look at the VIX futures, that's where they are, right? They are trading at a little over 13 and a third, let's call it.
Oh, that's nice. That's a good little trick.
Yeah. You end up seeing these things. You notice it. You'll end up seeing it happen a lot. Not that any of the numbers are wrong. It's just showing you where the point of inflection are, or when the slope of the line, goes from positive to negative.
Right. All right, Jim. Well, thanks again, and thanks for everybody for joining us. And I look forward to seeing you on Thursday with Amy. That should be a good session.
Thanks, Tom. Talk to you later.
All right, we'll see you, everybody. Bye.